very high-octane week ends today on Broad Street with a major regulatory action taken against three commercial banks through the course of the week. While the stock market continues to roller coaster, raking up billions of naira in market value, in the meantime, yields dive lower on all three dated instruments the Central Bank of Nigeria auctioned at its first primary market offer for the new year. To share some more insights and perspective on this is Johnson Chukwu, a market professional and group CEO at Cowrie Asset Management. A warm welcome to Arise Exchange tonight, sir.
Good evening, and thank you for having me.
Always a pleasure. Well, let's begin with some of the factors driving Nigeria's stock rallies 2023 right into the new year 2024. What are some of these, in your opinion?
I think what happened, what's happening in the equities market is that we started with a market that was driven by policy announcements at what we may call structural changes in the economy, or policies that we are supposed to lead to structural changes in the economy. For instance, the policy on removal of subsidy had a very salutary effect on the market, and then the policy on harmonization exchange rate also had positive impact on the market. So you saw a market rally that started strongly in May, but interestingly, the current rally is no longer largely driven by policies. If there's any form of policies, probably because you can say that fixed income yield is still low, and that the monetary authorities at the central bank had actually intentionally kept fixed income rates low. But I don't think that's the only factor in propelling the market. What we're now seeing in the market is some element of head syndrome, where a lot of people are coming to the market because they know some people came into the market and made good money. So people are now scrambling for any counter that is listed on the exchange. So I can say at the moment, the market is driven by exuberance and no longer so much of fundamentals as it were.
Absolutely. So policy in effect and the ebbs and flows there. But how would you say the current equities strong showing aligns with the economic realities of the country at the moment?
Well, I did an analysis of what the market has done, and it's clear to me that there is a disconnect between the macroeconomic performance of the economy, I mean the overall economic performance, and the market performance, the equities market performance. But this is not the first time we have seen this. We saw this in 2013. We saw this again in 2015. We've seen it in the past 10 years. We've seen it like 4 times, where the market rallies completely disconnected with the fundamentals of the economy or the economic performance. So it's not strange, but it also has a flip side. Because normally in those 4 times where I studied this next year we saw a market correction. So it's not out of place that at some point in the current fiscal year, the market may see some level of correction, depending on what happens in the fixed income space. If the fixed income space yield remains low, then we may see a market that will have minor correction. But if you see a sharp increase in fixed income yield, you may see a market that will suffer a very strong correction. But clearly, the market is disconnected from the economy today.
Right. Of course, certainly not the first occurrence there, as you mentioned. But let's take a look at the yields, like you mentioned now, which fell rather sharply at the first CBN Treasury primary market auction, which is conducted on Wednesday. What can we make of this in relation to where yields are heading in the new year?
You know, interestingly, it's clear if you look at the yield environment and the kind of stop rates that obtained in the market at the first auction, Treasury auction this year, that the central bank is not, has no intention to align short-term return with the inflation rate. Like you said, we saw a sharp decline. The last auction, the stop rate for 364-day instruments was 13.5%. And this week's auction, we saw a 12.24% stop rate for 364-day instrument. We saw the 91-day instrument at 7% and the 18-day instrument at 10%. But on the flip side, if you go to the OMO auction, you realize that OMO auction yield are materially higher than Treasury-based yield. And these instruments are virtually the same, other than the discrimination in the sense that local investors like you and I will not invest in OMO unless you're a bank and or a foreign portfolio investor. But the 3-day yield instrument, OMO instrument, closed at 17.75%, which is more than 700 basis, which is more than 500 basis points above similar maturity in the treasury bill space.
Right. Well, looking into the future now, let's get your outlook on interest rate direction for Nigeria in 2024. How should the CBN MPC decide and why, more importantly?
There are four factors that will shape the direction that the central bank will take in terms of interest rate policy. One of which is the level of liquidity that will be injected into the system from ways and means, because clearly we have an expansionary budget, and part of that budget will be funded from by central bank by ways and means. So if that, depending on the magnitude of that funding, central bank may want to increase rate to suck up liquidity or to reduce the liquidity that coming from it by ways and means. The other factor is the ability of the federal government to absorb higher interest rates. Clearly, if you look at the provision in the budget of 8.27 trillion naira for debt service, clearly federal government will find it difficult to absorb higher interest rates. So I don't think the central bank will want to increase rate that will hurt the federal government in terms of interest payment obligation. The other factor is an attempt by the central bank to attract foreign portfolio investment into the economy, which ordinarily what they should do is increase rates to see if that will be appealing to foreign portfolio investors. But until we clear the areas of unmet demand, until we achieve exchange rate stability and liquidity, increasing rates to attract foreign portfolio investors may not work. So these are factors I think will largely determine which direction the central bank will swing when it comes to interest rate. Of course, the first week auction, the first auction of treasury bills is already pointer to the fact that they want to maintain low yield on interest rate. And remember that once treasury bills yield is low, the banks will resist increasing deposit rates. So you're going to see a low deposit interest rate environment, but that does not really flow into or flush into the rate at which banks are lending, because the banks may still maintain lending rates in the region of above 20%.
So certainly lots of speculation there on what could possibly happen. But like you mentioned, first things first. But now let's take a look at Cadbury's shares, which rallied this week on the news of its $7.7 million debt conversion into equity. What do you make of this deal?
Well, in the first place, remember that what Cadbury did is basically to reduce their interest expense or interest obligations or interest liability by converting this 7.7 billion into equities. So for investors, what they see is that Cadbury's profitability should improve, because remember, equity holders are residual holders of residual beneficiaries. So it's only when profit is made and that is shared to all equity stakeholders, unlike debt, which is a prior charge on the income of the company. So investors are believing that this conversion will reduce the obligatory payment that Cadbury had to make, the prior charge that paid out before declaration of dividend. And that's why we saw a 42% gain in a single week in Cadbury shares. So clearly, investors are bidding that return on equity will improve with this conversion.
Very insightful perspective there. But of course, we can't have this conversation without touching on the CBN. Let's get your thoughts on the latest action against the boards of Union Bank, Keystone Bank, Polaris Bank. What do you make of this?
What happened this week has been in speculation within the financial service sector. The acquisition of the three banks by the supposedly core investors, had always been speculation that they were not funded from the balance sheet of the acquirers, and that they may have been funded surreptitiously from the National Treasury. I mean, there was even a case of somebody who resigned from one of the government agencies, principally because he couldn't align with a situation where a bank will be acquired with funding from a government entity. So this news has been there, so it wouldn't come as a surprise to us. And my position is always that if something was wrongly done, we all have collective needs to make sure it's reversed and appropriate things are done. For me, it didn't come as a surprise that central bank, after the report of the special investigator, the central bank had to intervene to change the board of these 3 banks, and obviously it would drive towards possibly reversing the acquisition process if it did not come from private capital.
All right, no surprises there, you say. Well, we want to thank you so very much for your detailed analysis into the Nigerian market and business week. As always, do have a great evening, and we'll see you again very soon. That was Johnson Chukwu, Group CEO at Cowrie Asset Management.